All right, we're recording. Hey, good morning, everybody. It's Wednesday here. We are going to do a little agent training, and we're recording this. We'll put it up on YouTube. Anybody will be able to watch it. My name is Pat Wilver. I'm the co-owner of Point Realty Group. Been an agent for a couple of years, investor for a couple of years more in real estate. We're going to go over basic real estate investing metrics, kind of with a focus on single family rentals. So that's the topic of discussion. I'm going to share my screen because we're going to be pretty Excel heavy on this. So here we go. Actually, Google Sheets, same thing as Excel though. So this sheet I made specifically for this class, and you're going to see me looking off this way. That's because that's where my screen is. So we're going off this screen. All right. So everybody, if you're here in person, you should be able to pull up this sheet in the email I sent you. So this is, and you can use this to evaluate any rental you want really, but I've kind of tried to strip out all the detail. Like here's the sheet. This is my detail sheet for like, big projects and stuff. So we will, eventually maybe get there, but we're starting off simple. Everything you see in blue here is inputs. So these are things that we know about the property or we need to find out about the property. Everything blue is something that's an input. We can edit it. Everything in black is all calculation cells and various things going on, right? So there are some key metrics that we're going to try to arrive at the end of the day to show our investor. And these are basically them right here. All right, we're interested in what's our cash flow, right? What is our return? And this is just for 1 year. What's our cash return on investment? And what is our total return on investment? These are like the big things that somebody wants to look for, but it takes steps to get to these values. So how do we get there, right? Let's go through it. So here's our property. In this case, we're just going to keep it simple, just simple numbers. We're saying, hey, here's a great rental we found, $100,000. Can buy it, right? And I'm gonna click through here. Repair estimate, $10,000. All right, this is what we do. We go look at a place. What's it going to cost to do this? I'm not going to get into how to estimate repairs. Just now. If we have some time later on in the class, we'll get there. But we need to know what the purchase price is. How much is it going to cost to repair it? We need to know what else about a property if it's a rental. What's the rent will be? Well, yeah. What's it going to rent for, right? And again, I'm not going to. In this particular class, get into how do we estimate a rent. We're just saying, hey, look, this is the rent estimate. ARV, do we all know, Elizabeth, you know what ARV stands for? Yeah, ARV. So that's after you do your little $10,000 in repairs, what's it going to be worth? I'm saying 120,000, right? Whatever. We hope that the money we put in is going to get us a little bit more, and typically it does. Appreciation, right? How much, what's the appreciation? I'm using 3%. In this particular model. This last 12 months, it's definitely been higher than that. Like in places like Richmond Hill, it's probably been closer to 10%, which I think is a little unsustainable. We never want to use 10% as our appreciation estimate. That's just unrealistic, unsustainable. I like 3%. If I'm trying to be more conservative, like maybe 2, that's kind of standard, inflation. I think Savannah might end up being higher than 3% going forward, but it's a good number. All right, so that's our property inputs. Those are some things that we need to know when we are looking at a deal. Financing, right? Most of the time, people are taking out a loan, right? So there's certain things about the loan that we need to know whenever we're running these numbers. So loan to value, right? LTV, right? You're familiar with that term? Our interest rate, right? Our term, is it a 30-year, 15-year? What's the term of the loan? Points, right? You know what a point is, Elizabeth? You run across that yet? So a point, lender point, right? So it's a charge. It's basically paying interest upfront. A point means 1%. So an $80,000 loan, if you're paying 1 point, you're paying $800 in points. It's just something to know. And then of course closing costs. And whenever we're running these numbers, for the purposes of this sheet, we are not going to be doing the portion of closing costs that are held in escrow for like property taxes and insurance, right? So you probably haven't run into that yet, but you've probably seen it on a settlement statement where they are the prepaid. So that is stuff that, yes, you're paying it at the closing table, but it's going to end up going towards expenses that we already model, right? We're already modeling property tax. We're already modeling insurance. If we count it here, we're going to be double counting. So closing costs is just your attorney fees, your appraisals, lender costs, but not points, because points are separate, right? That's what I'm saying, the closing costs. I typically do 2,500, maybe 3,000 is what your closing costs are going to be. All right. So that's our financing inputs, right? If you're modeling a cash deal, we just do LTV and we just change it to 0. Right. Boom. All right. And that's it. So this one, we're doing this like it's a rental property. All right. So expenses, we have some expenses in a rental property, right? Property tax is one of them. So do you know what a millage rate is? This is something.
Actually, I'm not very familiar with.
Okay. So, and this is something when you're looking, it's very important to know what your property taxes are going to be if you're looking at a rental property purchase. Mills is how we pay property taxes. So in Chatham County, city of Savannah, Chatham County, it's 44 mills, right? 44 mills is the tax rate. A mill stands for like 1,000. So this is like 44 divided by 1,000, is what that means. So if you look at this little formula here, right, you can see the formula tab in the sheet, right? Basically, that shows you the equation that we use in Chatham County. So we have B2 purchase price, right, times 0.4. All right. So Chatham County, they only take 40% of the property value as the assessed value. And they typically will reassess it. If you purchase a property, typically the next year, they're going to change the assessed value to what you paid for it a lot of the time, right? So purchase price times 0.4, and that will give you the tax assessment value. So it'll be, in this case, a purchase price of 100,000 will give you 40,000. And then they will take 40,000 times the millage rate. And you see how I have F2, that's the property tax rate, 44 divided by 1,000 mil. I think, what is mil, like Latin or something?
Mil.
Yeah.
Like a mil, yeah.
1 mil is 1,000. 44 mils is 44,000. I think it's from Latin or something, right? I think that's the yeah. So that's that math equation. You don't have to remember it necessarily if you have a sheet that just does it for you.
That's what I normally do.
Yeah.
I just plug it in there. I've never analyzed it.
So Chatham County, city of Savannah, 44 mills. Richmond Hill, I think, is like 36. So you can see, how does that change it up if we're out in Richmond Hill? Save a little bit. It's not, you're not saving a ton of money on a $100,000 house, but that's
Are these sheets accessible to us?
Yes.
Okay.
You should be able to follow the link in your inbox. I think you're already in there.
No, I'm in there. I'm saying it's like a shared document that we
Yeah.
can get in.
Well, I'll make sure everybody has everything at the end of the, yep. So property tax, right? Everybody understand?
Mm-hmm.
Perfect. All right, property tax. Insurance, this is something like I got an insurance guy, he gives me a quote. I don't ask him for a quote on every house I look at because I know a $100,000 house is going to be $750 roughly. You know what I mean? $200,000 house, probably $1,000, $300,000, I don't know, $1,300, right? This doesn't factor in flood insurance. We're talking a standard house, standard insurance, nothing crazy about it, right? That's what we're looking at. Maintenance and Capex, right? Normally these are separated into 2 different buckets. For the purpose of simplicity and like an introductory course, we're just going to talk about them like they're the same. So maintenance and Capex. Maintenance is just routine stuff. Hey, leaky faucet, hey, some paint, whatever. Capex is like a serious investment, like a roof, or, new floors or HVAC system. The difference,
No, actually, I don't.
So it's a capital expense.
Oh, okay.
Yeah, capital expense. The big difference, the first is how it's treated from a tax standpoint. So maintenance, you write off your taxes on an investment property in the year it happens. Capex has to be depreciated like you depreciate your house every year. If you have a rental property, you can depreciate it every year, and basically not have to pay taxes on depreciation. Same thing, if you put in a brand new HVAC, that's supposed to be depreciated over a period of like 7 years, I think, on your taxes. So if you install a $4,000 HVAC, you can write off, you know, probably $500 this year, $500 next year, et cetera, right? That's the difference. So they are different, but for this course, we're just trying to keep it simple. We're talking about these as if they're the same. I will typically do, if it's an older house, like these old Savannah housing stock, typically $1,500 a year. And per unit, if it's like a 4-unit, you know, big 4-unit, I'll say $1,500 per unit per year. If you got like a newer build in Richmond Hill on a slab, it's typically going to be less. You know, in this case, I'm doing 1,000. We're saying maybe it's a little newer house or something like that. Right. So some years you spend a lot more. Some years you don't spend any. This is an average, right? Vacancy, right? We always want to factor in vacancy. The place is not always going to be full. Tenants move out. It's going to take some time to find a new one. I typically use 5%. If you're running your properties well, your vacancy should on average be lower than that. But especially as busy as I get, sometimes I just don't have time to get around to showing a place. So, you know, shame on me, I guess. But so I typically do 5% vacancy. All right. Property management, typically 10%. Right. I have these little, so these are just some math cells. All right. So these are all of our inputs. This is everything we need to know. Do we have any questions about what these mean or how we figure them out before I start moving on?
How do you get the property tax rate? How do you submit that?
Yeah. So you just, if you want to just Google like,
Yeah, that's normally what I did.
City of Savannah.
That's why I don't know.
City of Savannah Mills. City of Savannah property tax. Like at this point, I just know it's, you know. So, all right. So the city, so this, it gets a little confusing because the city rate is 12.86, but there's a Chatham County rate as well. It's somewhere on here. Just if it's in the city of Savannah, it's 44. Except for some parts of Southside Savannah, like Georgetown, is less, but you have to pay a fire thing as well. You know, whatever. That's where you find that. So any place, and if anybody's watching this, you know, on YouTube or whatever, you know, any city you're looking to invest in, it should be a pretty quick Google search. Go to the city website, county website. You should be able to find that stuff. All right. Any other questions before I start moving along? All right, cool. So the first thing we're going to look at, you see, I've kind of broken this down into 4 different buckets: income metrics, property valuation metrics, debt metrics, and return metrics, right? And I've structured this because we're going to kind of go in order down the line. So gross rental income is easy, right? What's gross rental income? Is our rent estimate times 12. That's our yearly gross rents. All right, so 12 grand. That's gross coming in. Vacancy loss, right? 5%. So that's just 5% of our gross yearly rents. Give $600. Other expenses. All right, so that's our maintenance, capex, property management, taxes, insurance, all that stuff. That's our other expenses every year. And then we arrive at net operating income, or NOI, right? This is a very important, you know, kind of thing to remember. I'm gonna just like highlight it. You know, NOI is important, right? NOI is how much money you're making. Like if you bought this thing straight cash, no loan, that's how much money you're gonna make in a year. That's gonna be your cash flow, right? Is that gonna be your total return on that investment? Why not?
Because you get equity in the home.
Because you got equity in the home, right? So what do we have building our equity every year?
I mean, the payments going to your
So, say there's no loan.
no
Own a cash. What do you got growing the value of your home every year?
or appreciation.
Appreciation. So that appreciation, that's like if you buy stocks, right? Say you go buy Amazon, you know, stocks are on sale today. I might go buy some, you know. So you buy some Amazon. Amazon does not pay a dividend, I don't think. Maybe they do now. Say you buy a stock, doesn't pay a dividend, you know, but the value goes up, right? Did you make money if you still hold that stock? Did you really make money?
Unless you sell it.
If you don't sell the stock, you didn't really make money. It's on paper, it's fake. It doesn't exist until you sell it. Same thing with the house. You might buy a house for 100 grand. 10 years later, it's worth 200. Did you make 100 grand of profit if you still have the house? You didn't make it. You have it, it's equity, right? But it's not really yours, you know, because the house is not it's not cash. Like cash in the bank, that's cash. Now, if you're getting rental income, you're making that money. If you made $3,000 in rental income, yeah, you made that money. That's in your pocket. That's cash. You can go buy shit with it. You know what I mean? So we'll get there. That's why there's a cash return on investment and a total return on investment. But this net operating income is how much money you make if you don't have a loan against a property, and it doesn't factor in appreciation. And if you do have a loan, it doesn't include your loan payments. All right. So net operating income. Why is that important? If you're going to get a loan, why do we need to even know what does net operating income matter if we're getting a loan?
You got to pay it off. So you want to pay it off.
Right. But you're gonna, so here's our, if we go down, here's our principal and interest, right? 5,200 a year. So, 6,750, 5,200. Okay. We got enough to cover it. But this NOI doesn't really matter a whole lot necessarily if you're getting a loan, except for cap rate, really. So who knows what a cap rate is? Who knows what a rent multiple is?
This is
just some new stuff. All right. So this is property valuation metrics, right? So a cap rate is a term that an investor will use to value a property, right? So cap rate, let's just jump right into cap rate. All right, I have it third, but let's jump into it. Cap rate equals NOI divided by purchase price, or sometimes people do NOI divided by the all-in cost, right? In this case, I did the all-in cost. So we are factoring in the purchase price plus our repair costs. Your all-in cost is 110,000, right? That's in the denominator of that equation, and the numerator is our NOI, right? So that cap rate is 6.14%, right? What that means is that kind of means two things. First, that's your return, that's your cash return on investment if you buy it straight cash. You buy this house straight cash, you're going to put in $110,000. You're going to make 6750 of NOI. 6750 divided by 110 gives 6.14%. So that investment yields you 6.14% or at least your first year. Typically rents go up, so we expect that to increase every year. But 6.14% cash. You put in 110. Here's 110 grand. I know a year from now, I'm going to have 6.14% of that 100 grand in the bank account cash. Also, hopefully I'll have some appreciation as well, but that's not in my bank account. That's just fake. It doesn't exist until I sell. That's cap rate. So that one, it's important. And the second reason that's important is it allows you to compare investments in an apples to apples kind of way, right? Because you can change up a lot of shit depending on your financing. So like, let me compare cap rate. Like I said, that's your cash yield if you buy it straight cash. Here's our cash yield here with debt against it. It's actually lower, 4.64%. Typically, we expect it to be higher, right? There's some reasons I'll explain why this, I wouldn't buy this deal looking at these numbers. I wouldn't buy it. But that's our cash yield with the loan. But check this out. So it's 4.64, right? Well, what if I come up here and I drop the interest rate to 3.5? Look how much I jumped up, 7.21. All right, now our cash ROI with debt is better than our cap rate. But what I'm saying is, if you play with your financing, you can change these numbers so much. That's why you always want to shop around for different debt, and but the cap rate ignores financing. It's just, let me look at this property. And if you got a property that's if it's the same, say you got two houses that are exactly the same neighborhood, same everything. And if you can get one at a higher cap rate, buy that one, right? It doesn't matter. You might, for example, there's a bank I like to use in Savannah. They only lend in Chatham County. They don't do Hinesville, right? So, say I had a deal in Hinesville and a deal in Chatham County. I'm like, which one of these do I want to buy? I look at the cap rate, Now, I have this as a property valuation metric. All right. So we're all talking like, how does this, relate to the value of the property? So the way it does is investors, and this cap rate applies more to like bigger multifamily investments. You can still look at it on a single family. It's not as applicable, but on a big, like a 50 unit building, they're not doing a comparable sales analysis. They're not looking at, like when you're looking at a house, right? they're looking at cap rates and they say, hey, look, a class A multifamily building in a tertiary market like Savannah, Georgia should be selling at a X cap, probably 5 cap, right? And that's how they value them. And if it's a class C multifamily in Savannah, they'll probably want it at a 7 cap, right? So as the property gets shittier, investors expect a higher cap rate because it's a shittier place. They want to make more money on it. Does that make sense? Yes, if you're investing in like a great office building in a great city and it's just great tenants, or like an Amazon warehouse, like Amazon warehouses right now, investors are paying a shitload of money for them because it's like, fuck, it's Amazon. You know what I mean? So you look at that equation, it's NOI divided by, your purchase price, right? So as purchase price gets bigger, what happens to the cap rate? It's going to get lower, right? For the same NOI. So you see how this is a property valuation. An Amazon warehouse that somebody will pay a 3 cap for, say it generates, $10,000 in NOI, right? Let me just set up I'm going to set up a new cell, right? Just to kind of illustrate this. So.
Well, I said that, is everybody tracking with how all this is getting broken down? Any questions?
No questions.
So I'm gonna illustrate. This is important, right? I might be diving a little bit too much into cap rate for like a introductory course, but it's an important, and it's something that a lot of people don't understand. And when you're dealing with an investor, especially somebody who kind of knows what they're doing, and you don't know what a cap rate is, like you're gonna automatically lose legitimacy with them, right? So let's say there's an Amazon warehouse you can buy for $1 million. Did I put enough zeros in there? Let me see. For $1 million. And let's say the NOI is, 50,000. I don't know. So that would be a 5 cap, right? You see that? So, maybe 3 years ago, people were buying Amazon warehouses at a 5 cap, but things have changed now. People are really into that kind of asset. But let's say, say somebody bought it for $1 million 3 years ago, 5 cap, right? Well, say investors, and this has happened, investors all around the world are more interested in that kind of asset than they were 3 years ago. That makes it more valuable, even with the same amount of NOI. So maybe say that you can sell that for $1.5 million now, but it's the same NOI. That cap rate went to 3.33. Do we see how? All right. So say you got a rental out in the hood. Say this thing's getting you what, 6750, and all in for 110, so 6.14 cap, right? So say, if you're getting this much NOI, let's say the place is like in a rough spot, and it's a rough place, and like you're gonna have transient tenants, whatever, you probably want to pay a little bit less for that, right?
Yeah.
Maybe you want to get it for 90. Cap rate goes up, right? Say it's in a great, super, like gated freaking suburbia, whatever, the kind of tenants are going to be there for 5 years, easy investment, newer house, worry free, right?
Yeah.
People pay more for that shit. So, say it's that same NOI, but say they'll pay 200 grand for it. They probably wouldn't, but you say they would. All right, that's a 3.38 cap, super low, right? But you see how it changes things, right? So that's why it's a property valuation metric. All right. Does that make sense?
It does.
Yeah. So you can typically expect in better neighborhoods to have a lower cap rate because people are more willing to pay for the same amount of rent as they would buy somewhere else, right?
Mm-hmm.
Now, single family homes, it's not super applicable, right? It's just kind of something. When I'm looking at a single family home, I'm not looking at the cap rate as a valuation because people value single family homes based off the one next door that sold. They don't, that market, you're not just competing with investors, you're also competing with just Joe Schmo who wants to buy a house. So it's not really you don't really use it to value a single family home, but you just look at it like, hey, if I bought this thing cash, this is what I would make on it. It's cap rate. Cool. So That's why it's a property valuation metric. Now, we also have the gross rent multiple. So that is your purchase price divided by your gross annual rents, right? So that's something that a lot of people use. I prefer to use it based on like a monthly. So I just call that my rent multiple, right? So this one would be 100, right? So that's, and I typically do that for all in costs. So let me just change that.
What are we looking at? The rent multiple?
Yeah, the rent. When you say, I always say like, oh, that should sell for 100 times rent, right? It's something I say a lot. That's typically what I use and what a lot of other investors looking at a single family home or like something. It's more like a shoot off the hip kind of thing versus cap rate. You got to like do math and stuff. You know what I mean, to figure out.
So I hear about the 1%.
Yeah. So the 1% rule, 1% rule would correspond to a rent multiple of 100. 1% rule means that your monthly rent, if your monthly rent's 1,000, your purchase price should be 100,000. It's the 1%. People like to use this 1%. 10 years ago, it was a 2% rule because you could buy them that cheap. You can't buy them anymore. You can't even buy them one. People call me up looking for, I want a 1% rule house in the suburbs. Okay. Good luck. Like, that doesn't exist. So rent multiple is a way that I really value a lot of my deals. It's off the cuff kind of thing. It's something you don't have to calculate NOI. You don't have to calculate property tax. It's just a much quicker way to come up with a value. And
because this is the way I've always done it. Just real quick,
yeah,
off the hip, and that's where like I fail at this side of it because I haven't really dug into it.
Both are important. Now, you don't want to spend all your time plugging shit in a spreadsheet if you can look at a deal and be like, that's a shit deal.
Yeah,
I'm not going to spend any more time on it.
Yeah.
Once you find a deal that you're like, that might be a deal, then you do all this shit, right? So rent multiple, and I'll just tell you, city of Savannah, if I'm buying in Kyler, Brownsville, West Savannah, some parts of East Side, places that like there are a lot of condemned houses, it's run down, I'm looking like 80 times rent is where I want to buy, right? And that's where a lot of people want to buy. So 80 times rent. So if I say that right now, this is 110 times rent, right? Which isn't bad for some neighborhoods, just depends on the neighborhood. But if we were over there and, say I found a place that I knew would rent for $1,000, typically a 3-2 anywhere in Savannah is going to rent for at least $1,000. All right. If it's in decent shape. So say it's $1,000. Well, shit. And I got to put 10 grand into it to get that $1,000. I need to buy it for how much? If I'm looking for an 80 times rent kind of neighborhood.
90?
70.
70.
I'm buy it for 70. Buy it for 70. I'm putting 10 grand into it. It's going to rent for 1,000. Here we go. Rent multiple 80, right? So the lower the rent multiple, it's kind of the opposite of cap rate, right? The lower the rent multiple, like the more like NOI you're getting, because you're the more all right, cool. Yeah. So anyway, if you're buying in a, if it's a sketchier asset, you want to have a lower rent multiple, right? If it's a safer asset, you can have a higher one, basically. 80 times rent right now in this market is like super hard to find. But I still try to stick to that. Like, if I'm buying something a little rougher, what I'm seeing right now is 90 to 100 times rent, even in like some of the worst places. I'm seeing a lot of people buy 100 times rent right now. Okay. I'm seeing like a nice Starland duplex, like a nice part of Starland fixed up. It's nice, 150 times rent. They'll sell for anywhere from 130 to 150, kind of depending on, some specific details. I mean, you're kind of seeing that too, right? Like, yeah.
And I wasn't involved with, I kind of came a little late, so I apologize. So one of the things for the new approach.
Hey, Wynn, speak up because I'm recording this too.
Yeah. So Pat and I, we do this all the time. So it becomes second nature to us. We throw out these numbers, we throw out these terms, we throw out everything else. For you guys, if I were to ask you, what would a monthly payment be on a house that's worth $150,000? If you were to contract on a $150,000 house today, and somebody asks you, what's your mortgage payment? One, would you know that answer? And two, do you know where to go to find that answer?
I just always Googled it.
Okay, you can Google it. It's a great way to do it. Okay, same thing, right? So all of this is predicated on payments, right? For an investor, they want to know, how much can I make every month? Well, in order to know how much you can make every month, you need to know a couple baseline things. How much am I paying, and how much can I get? Those are the two biggest ins and outs, right? Regardless of the underwriting, which is this best underwriting, is fantastic. But all the NOIs and cap rates and all these various things really don't. That's digging way deep. For your entry level thing, if I'm buying a house for $150,000, your 1% rule is going to say, I want to try and get $1,500 rent. And Pat had said that's very difficult to do, right? So at what point is it not a deal for somebody? And the answer is, you're going to take your mortgage payment, wherever that is, whether it's through financing. Like say you get a 30-year, you can go on to Bankrate, you can go on to all these various websites and do a mortgage calculator, right? You factor in there's $150,000, a down payment, and you get a ballpark, right, for like a 30-year loan. A lot of investors don't do 30-year loans. They'll do shorter term loans, they'll do balloons, they'll do ARMs, they'll do private money, they'll do hard money. They have a whole bunch of different financing, which if you're talking to investors, we need to be aware of all of that. But I mean, they deal with a lot of that stuff themselves. So you really don't get too much into the weeds there, but you need to know. So let's do a real quick exercise. Let's find out what a $150,000 house, kind of a mortgage payment is real quick. I don't want to take time away.
No, let's,
But
so I've got, we're gonna talk debt here in the next little, well, yeah, a good time to move on to that, I guess.
Sure.
So let me sit back down and get back on the,
and I'll finish up with this. So let's check.
yeah.
So if we're looking at,
So before we jump into the mortgage payment, do we have any more questions on the rent multiple, on cap rate? Are we making sense here?
Yeah, it makes sense, because I've always just done like general percentages. I think I've always done like 5% for like closing costs to calculate all that, but I've never dug this deep.
Yeah. So there's our property valuation, right? The biggest ones I use, I'm just gonna, like, honestly, I think rent multiple, and for what we're doing, single family home, that's more important than cap rate, honestly. So I would say that's your more important from a valuation standpoint. If you're just, what's the value here? Rent multiple, right? Nicer neighborhood gets higher. You're in Richmond Hill. I mean, if you're buying a single family house to rent in Richmond Hill off the open market, I think you're probably a little crazy. Unless you're just sitting on buckets of cash, like some folks. If you're sitting on buckets of cash, hey, if you can make 4% on that cash and get appreciation, sweet. Because otherwise the Fed's just printing all that money and it's, inflation, right? Everybody's got different things to look for, so rent multiple, right? I also put in here free equity, right? That's not like an official term. That just means, hey, we bought it for 100 grand. We were putting 10 grand into it and we think it's going to be worth 120 grand when we're done. So we got 10 grand of free equity, right? I just like to see that, it's not an official, like, you're not going to see it on Bigger Pockets. There's probably a more, fancy word for it. Whatever. Appreciation too, year one, $3,600 bucks, 3%. And that's going off our ARV of 120,000, right? Because we already got our free equity and then we're getting some appreciation too. Right, sweet. So I just got it in there. I don't know if that's really should be in property valuation, but that's where I put it. So debt, right? We were talking about debt. How are we looking at debt? You got your mortgage payment, right? Now, your mortgage payment, typically a traditional person, includes your taxes and insurance as part of the payment. But we already accounted for that as an expense. So we're not going to double count it here in our debt metrics because we've already accounted for that expense, right? And we have to account for that expense before we calculate NOI. Why? Why do we look at property taxes and insurance? Even though we're paying it in the mortgage, why do we look at it before we get to the mortgage in this analysis?
We're trying to calculate our debt that's going out.
What do we do with NOI? What's NOI used for?
Valuation.
Where do we use that? What formula do we use NOI in? That we cap rate. Yeah. So let's refresh. Cap rate is what? What is cap rate? Before I want to make sure we really drill this, you know, before we keep going. What is the cap rate?
I mean, I think I'm getting confused now because we're kind of going through it.
Yeah.
It's a lot. It's a lot. This is kind of some heavy lifting that we're going over, but they're all important concepts.
So is it the percentage of money that we make?
It can be.
I don't know how to.
So it can be the percent of money we make if we buy the property how? All cash. All right. If we buy the property in all cash, that is and the official word for that money make, we call it yield. All right, or we can call it the cash ROI, cash return on investment. Some people call it cash on cash return, right? A couple different words for it, means the same shit. You know, cash on cash return, cash on cash ROI. If you buy this thing straight cash equals cap rate equals 6.14% in this, right? In this equation, right? That's why we have to look at taxes and insurance, even though it's part of the mortgage payment. That's why we have to look at that first as part of NOI, because that's something you're paying whether you have a mortgage on it or not. You're paying that shit. So that's why we talk about it here, even though, you know, and I do have a mortgage that does not have an escrow. I got to cut a check for insurance and taxes, right? That's investor stuff. You know, you're not going to deal with that with your regular buyers. Anyway, we refresh cap rate. All right, remember that. So here's our debt metrics, right? So we inputted all this stuff, you know, up at the top, everything about our loan. LTV stands for loan to value. All right. Typically on an investment property, conventional investment property, it's going to be 75 to 80%. We're doing 80% for this. Our interest rate, right? I think right now they're as good as like 4%. It's probably as good as it gets right now.
For investor,
yeah. So 4%. The term, typically 30 years, right? If I have any client, I always recommend don't do a 15-year loan. Why would you do a 15-year loan? This kills your cash flow, right? 30-year. You know, I would always push people towards a 30-year, especially an investor. Everybody's got different things, but yeah, 30-year. All right, points. Do you remember what the point was?
Yes, that is like interest we pay up front.
Yeah, and if I'm paying 1 point on an 80% loan to value loan for a purchase price of 100,000, what's that? 800 bucks. Yep. All right. So cool. So we have all that stuff, and all this is just being calculated for us automatically. So we have our financed amount, right? 80,000, 80% of 100,000. We have our principal payment. You see that formula here? PPMT. All right. Excel has a principal payment formula, and it amortizes for you. So yeah, it's pretty cool. So, and they also of course have one for IPMT. All right, interest payment. All right, there is a formula, right? You do not need to look up the formula because this shit will do it for you, right? You know, and so here's something that I have to explain here, right? When you buy a loan or when you buy a house and your loan, typically, have you guys, you own a house, right?
Yes.
You own a house? You have before. So did you notice how your principal payment, part of your payment goes up every month? All right, that's because of the way it amortizes, right? So, you know, typically most regular home buyers and most regular investors will have a 30-year fixed, fully amortizing loan, right? So starting out, you know, the banks know that you sell your house on average every, you know, 7 years, right? Every 7 years on average, somebody will sell their house. Like you buy a house on average, 7 years later, you're going to sell it. The banks want to get their interest up front. So they take more interest when you first buy a house. If you got $1,000 payment every month, 700, that shit's going to be interest. 30% is going to be principal. And on your very last payment, it's going to all be principal, right? And that's how it rolls, right? This formula in Excel automatically does that, right? Automatically does that calculation. Makes sense.
Yeah.
All right. So that's why you'll see, and this is for the whole year, right? I have this set up for the whole year. I'm not going to really get into how I do this formula, but you can see, you know, there's the cool thing I like about this, you know, you can freaking click on the question mark. Oh, and it tells you exactly what's in this formula and how it works, right? So you can read that if you'd like. If you wanted to set this up to be a monthly payment, all you'd have to do is take the number of periods and take basically these two here, and just multiply it. D4 times 12, D24 times 12. And that would give you your monthly payment. We're doing this yearly. We're doing a whole yearly thing. So this is yearly. Hey, that year I'm paying, you know, this much principal, this much interest. This is my total year one principal and interest on this note. Makes sense. So more is interest, less is principal, year one. All right. If we freaking go in here and we do, what's year 30 look like? We just change that number.
Oh, that's really cool.
Yeah. Look how much more, you know, look how much more principal it is versus, you know, interest is barely any of that last year. Right. So that's pretty cool. So that's how we change that. Right.
I didn't know you had that formula in there. I've always done everything online
Yep.
on this little calculator.
I used to as well. I actually had, I had a sheet. I didn't know about this, and I did my own math to get it. Yeah, it was a fucking
nightmare. It was a nightmare. That's what
yeah.
I'm so struggling with.
Yeah. So yeah. So here's our principal and interest, right? Boom, debt matrix. There we go. That's our debt, right? So, principal. What happens to that principal payment?
Over time?
Yeah,
it goes up.
It goes up, and that principal payment. Does that money go away? Are you losing that money? Are you losing the value of that money?
No.
No. Why not?
Because you're gaining equity?
Because you're gaining equity, because that's going towards paying off your loan, right? That's kind of like that appreciation, right? The appreciation happens for free. This principal payment is you paying down your loan. So that $1,400, yeah, you don't have it in cash anymore, but it's in that house. You know what I mean? The interest payment, of course, that's just money you spend, which you can write off on your taxes in an investment property, right? So that's our principal and interest. So now we get to our return metrics. All right, here we go. This is our cash flow. All right, our year one cash flow. All this equation is NOI minus principal and interest, right? That's our cash flow. All right. After all expenses are paid, that's how much money the investor puts in their pocket because they own this asset, right? It's not bad, right? Face value, you know, something close to $200 a month, right? And remember too, you know, we've got this $1,000 of maintenance. Maybe they didn't spend any money that year, you know, so they might have, you know, 3,000. Maybe they spent 5,000. You know what I mean? That's it. So, and then this year one total return is the cash flow plus the appreciation plus the mortgage principal pay down. All right. So $7,100 a total return. But it just so happens that most of that is in equity in that house. Right.
And that's why you have it broken up. So you can explain.
That's why I have it broken up. Right. So here we go. Cash flow, total return. There we go. Right. And you can see how playing with the debt, you know, changes. Well, let's go through all the metrics, and then we'll get in a little bit about how you can play with debt. Right. So here's our cash invested, 33 grand. Right. That's our down payment, plus our loan costs, plus our rehab budget. Right. So, you know, our down payment was 20,000. We had 13,000 of other costs. 10,000 of that was in rehab, and then we had closing costs and points as well involved in that. Right. So that's our cash invested. That's how much money we had to wire to close on that deal. There it is. And then this is our total equity. Not at the end of the first year, at, you know, once that rehab's done, that's how much equity is in it. Right. 40,000. All right. That's and then the total equity is the down payment plus the rehab budget plus the free equity. All right, 40,000. 20,000 is our down payment. 10,000 is our rehab budget, and we have that 10,000 of free equity. You remember how we came up with that 10,000? So we bought it for what, 100,000? We put 10,000 into it,
We expect to be 120.
and it'll be worth 120. So that's how we got that $10,000. Just, that's our free equity, right? That's equity we didn't pay for. It just exists because typically a house that needs to be fixed up, if it's worth 120 as is, and it takes 10 grand of work, typically people aren't going to pay 110 for it because most people don't want to do that work. They just want to buy a shiny new house, right? That's how investors can sometimes find some value if they know how to do that work and they're not afraid of it, right? So that is our equity. Makes sense. You got it? Perfect. So knowing all of these numbers, we can now calculate these numbers. All right. Cash return on investment. All right. 6.38%. All right. That is our cash flow here divided by our cash invested. Right. So buying this property, we had to put up 33 grand. Right. On that 33 grand, we make a cash flow of 2,100 bucks. 2,100 divided by 33 equals 6.38%, right? So that's a pretty decent number, right? That's not crazy. You know what I mean? A lot of times, if I'm buying something, I like to get double digit cash ROI if I can, right? It's hard to find those deals, and a lot of times you're going to have to do, work for them and rehab them and stuff. But that's not bad. I mean, shit, what do you get in your savings account in the bank? Probably 0.15%, right?
You lose money.
Yeah. I mean, yeah. So that's not too bad. That's your cash ROI. Now your total ROI is down here. That's 21.47%, right? So that is our total return, 7,100 bucks divided by that same 33,000, right? So a 21%, do you see where that's coming from?
Is that at the end, as it's all said, like if we were to sell the home?
So this sheet does not take into account selling costs, right? So if you sold the home, I mean, if you didn't pay any commissions, if you didn't pay any closing costs, then yeah, that's what you would get. If you sold the house at the end of the first year, that would be, your return. And so, and what I did not include on that is, the free equity. I'm only including this year one total return.
Oh, okay.
Right. I have other sheets that we're trying to keep this simple.
Okay.
Right. So in this case, that's actually, really pretty good.
Yeah, that's pretty good.
That's a pretty good return on your cash invested, right? So see that 21.47%. Now, check this out. This is why leverage is so big.
So you want to do cash down? Okay.
So if you're doing this shit cash, look at that number. It's cut in half, right? It's cut in half. It goes from 21 down to 9. Do you understand why that's so different? What changed? All right.
You have more money out of pocket. You're not using other people's money.
You're not using other people's money, right? You see this, Elizabeth? You see total cash invested. You see cash invested. If we do a straight cash is 112,500. All right. And you see year one total return. If we do it straight cash is, 10,350, right? You see those two numbers? Now stay looking at those. I'm going to change that back up to 80% loan to value. Watch how those numbers change. You see that change? So your total return dipped about 3,000, not too big, but your total cash invested changed massively, right? That total cash invested is in the denominator of the return on investment equation. That's why that number changed so drastically, right? That's called leverage. All right. You take out debt to buy an asset. It will juice your returns typically, right? Typically it should. If it doesn't juice your returns, you shouldn't take it out because it's not doing anything for you, right? But in this case, it more than doubled our return on investment, right? Did not change the cap rate, did not change anything about the property itself, did not change the rent, nothing. All it changed is how much money we had to bring to the deal, right? And when the interest rates are as low as they are, you don't have to pay a lot of money, right? Let's look at it. You know, traditionally interest rates have been like, you know, like my parents bought their first house, I think they're paying like 13%. What does that look like? 13%? Oh my God. I mean, you're fucking losing tons of money, right? That's leverage. That's what leverage does. And that's why, you know, yeah, that's why I like, in a nutshell, people are like, why do you like real estate? Leverage is why I like real estate, right? If I could take out a 30-year loan to buy Amazon, I probably would. And if it was at 3.5%. Problem is, you can take out loans to buy stocks, but if your stock starts going down, they liquidate it, they sell all your stock, and they take your money. They don't do that with real estate. If you buy a house, the value can go down 40%. As long as you still make your payment on time, doesn't matter, right? And it's 30 years, it's a low rate. That's why real estate is so powerful. It's because of leverage.
Runs on leverage. When you're buying a car, like people aren't paying cash for a car. Like,
Yeah.
People don't credit cards. Everything you buy. Like, how many people pay cash for something nowadays? No, you put it on a credit card.
Yeah.
Leverage into credit card money to buy what you want today.
Yeah.
And you're paying them back at some point. Whether you want to pay them back that full amount, you don't have interest. Whether you want to pay them back a little bit and then they make money. But like the world revolves around leverage. Yeah.
So leverage, right? That's and we went through all of that basically to get down to, you know, kind of showing the power of leverage, right? It makes a huge difference. So this cash and you know, you'll evaluate enough deals for whatever reason, you know, this one, the total return on investment looks pretty juicy. The cash isn't, sometimes it's the other way around, right? But that's what you make that year, right? Now, of course, this is simplified, right? You know, if we look at, you know, my big sheet here, I'm looking every single year, year 2, 3, 4, 5, 7, right? And I'm looking, you know, you don't ever have to get this complicated, right? If it's something you're interested in, great. If not, don't worry about it, because, you know, this is a part of real estate that I like. You don't have to like it, you know, but I think you should understand the basics, right? So, you know, that changes, you know, I'll just show you. Internal rate of return, you know, is a metric that we look at. That's basically this, that's what you're making every year. So in this case, you know, a pretty good approximation. Shit, I can't, come on, go away. Come on, there we go. All right. You know, this would be like 21, like you can expect to probably be making 21% every year. And it should go up as rents go up, right? So, I mean, that's sweet. I mean, you don't find 21% in the freaking stock market.
Well, we did it with an FHA for.
Oh, and if you do FHA, well, check it out. So if you buy this thing, so say you do an FHA, you know, 96.5%, how's that going to change it?
Oh,
it's going to be massive, right?
This is what I just
look at that. That went up to 38% because you barely put any money down. You know, if you do
almost 60.
Yeah, if you do a VA loan, you know, it's 40. Now we have these, if we cut out the repair costs as well, 181% total return on investment, even though our cash flow is only $960 a year, right? Because as we take out more debt, what goes up? Our loan payment, right? But 181% total ROI, 27% cash ROI on a measly $967. But why is that? Because what's our cash invested? $3,500. That's why the VA loan is so sweet. Now this is kind of a dangerous place to be, because you don't have, you know, if your rents go down, if you misjudge your rent by $100, right? Which isn't impossible to do. What do we look like now? We're losing $59 a year, right? So, you know, that's another effect of leverage, is it amplifies your gains, it amplifies your losses, right? So, but the reason I like real estate, especially rental properties, is it's typically pretty easy to estimate what your rent should be, right? Especially you got enough time in the market, like you should know about what it's going to rent for. You have your expenses. The biggest thing when I'm talking, you know, especially new investors, I say, you know, you kind of go over this and you say, look, you're going to be a landlord. It's a business. It's not a passive investment. It's a little more passive than some, but you still need to be involved, and if the HVAC goes out, like you got to tell these investors, you got to have money set aside for repairs because it's going to happen. And it could happen the first freaking week you own it.
Yeah.
And, when you have this kind of leverage, if you're only cash flowing $1,000 a year, you got to spend $5,000, like that, that's going to hurt you a lot. So that's the leverage, but you see how that changes things, and why that's important. Now, let me set everything back to where it was before.
While you're setting that back, we take a quick pause here. So we're an hour in, right? This is pretty heavy lifting. Some of the words, concepts, everything that Pat talks about, he talks at a different level than most realtors. Is this still somewhat, I know it's gonna be new, over our head?
That's why it's recording.
Yeah, this is something I want to have to watch again,
We want to
especially.
make sure that you're understanding, from the basics, like your building blocks, right?
Yeah.
Pat didn't get to this level overnight. Like he joined us, I started walking him through some stuff, and then once you got good footing, you kind of went off on your own.
Yeah.
You kind of built your own stuff. We want to make sure that you can jump into this level. And it's recorded, which is good. We want to make sure you understand the
Yeah.
basics of, like I said, I mentioned earlier, mortgage in or rents in, mortgage out. If that doesn't make sense, like none of it matters. Like you have to make sure that you at a kind of investing 101.
Yeah.
Most people want $200 a day, right? So
Yep.
your cash flow. Back to the napkin stuff. So you have $150,000 house. The mortgage payment on that is going to be what's the mortgage payment on $150,000 house?
Probably
Let's see.
going to be around $1,000 at
Real quick,
4%.
figure it out, right? Let's do it real quick. Let's go to.
Well, here I got everything in here right now. So let's just so equals yearly principal and interest plus property taxes plus insurance divided by 12. Oh shit! It's I need to do minus.
Yeah, I'm gonna say it's probably gonna be about $1,050.
I'm coming up with 590. Oh, that's 100,000. Which should be about right at this interest rate. So 150,
150,
860. That's at 4%.
4%. That included.
Yep.
Principal and interest.
Yep.
Everything.
Yep.
That's all really help.
Yeah. That's on a
30-year.
your insurance is probably going to be a little bit more. That's 30 year. Yeah, 860. That sounds about right. I think that's about right.
Basically,
Yeah.
So if you buy a house, if somebody wants to buy a house for $150,000, their mortgage payment, because they have to pay every month to the bank, is going to be
860.
right? Let's round that up to $900. Let's use
$900.
Even $900, right? So your 1% rule is going to say, I would love to get $1,500. If I'm buying a house for 150 grand, I would love to get $1,500 in rent. It doesn't happen, right? Those are kind of fairy tales, right? So at some point, it's a good investment. Some points it's not. So say it's $150,000 and you can get 80% rents, right? 80% rents would be 80% of $150,000 is $120,000. We'll do it the same way there. 80%. So you're looking at $1,200 a month at your 80% or
You're not point.
Your point
0.8%.
20%.
Yeah,
80 times.
No, that'll be like 120 times rent.
Or 100.
Yeah.
Right. So you say that's you're looking weird. Okay. So if your mortgage payment is $900 a month, how much more than that does an investor need to say it's a good deal? Right. If you pay out $900 a month,
Probably 1,300.
and you bring in $900, is that a good investment? If you're paying out $900 and bringing in $900, is that, are you going to want to do that?
No.
Right.
No.
If you're taking out $900 and bringing in $2,000, is that a deal? Of course. Now, somewhere between not a deal and a deal, every investor is a different threshold of what they're comfortable with.
Yeah.
Right. And that's where we need to make sure we're kind of working the back of the napkin numbers to see even if I want to show it to you. Because you don't want to drive all the way out to Timbuktu and you're like, hey, rents in this neighborhood are $700. Your mortgage payment's gonna be $900. Why don't you buy it as an investment? And they're gonna look at you like, you don't know what we're talking about.
Yep.
So when you do it enough, like Pat does it, you know, when you look at neighborhoods, you look at houses, you just kind of, it runs in your head and like deal, not deal, deal, not deal. But this is the basis of where he and I are getting our repetition when we look at 10 deals a day or 20 deals a day. So you got a mortgage payment of $900. Most people want to make at a minimum $300 or $200 a month on that, right? So if you have $200 you want to make, and then you have a little backwards math on, you have to set a little bit aside, right, every month for your expenditures and your maintenance, which is, we already talked about $1,500 per door per year.
Typically, yeah, I mean,
Yeah.
yeah.
So that's about 125, 150 bucks. So tack that on top. So you got 900. You want to make 200. That's 1,100. Tack on another 150, 1,250, and you had said 1,300. Right. So the scenario ran real quick in Pat's head. Boom. If I can rent it for 1,300, it's a deal. If I can rent it for 1,000,
Not a deal.
not a deal. So anything over 1,300 would be a juicier and juicier deal.
Yeah.
For your investment.
And I'm typically, you know, people, you're talking 1%. People throw around 1% and 100 times rent. That means the same exact thing. 1%, it just depends on whether you're applying it to the purchase price or the rent. So if I'm saying, hey, it's $100,000 house, the 1% rule means I probably want to get at least $1,000 in rent, 1% of 100,000. Or if you're looking at the rent is $1,000 and you apply the 100 times, you know, that it's the same thing. So it just depends on whether you're going from purchase price to rent or from rent to purchase price. But typically, like if I'm looking in a nicer, maybe Georgetown, maybe Richmond Hill, you know, Southside Savannah, some of the nicer places, like 120 times rent might still be a good deal. You know, that would be like what, about 0.8%, right? You see how that goes? So, you know, if it's renting for, you know, 1,300, you know, and you're 120 times rent, you know, what's a better mental math guy? 1,300 times 120, 156,000, right? That makes sense. That's in like a little bit of a nicer spot. But if you got the same 1,300 in kind of a nastier place, say you want 80 times rent, 1,300 times 80, 104,000, right? Same rent, different areas, different price you want to pay for them.
Makes sense.
Yeah, different neighborhoods.
Yeah.
There are three different ways that most people invest. We just had a conversation with an investor out there, right? Who wants to get in. A lot of people want to get into investing. They're like, hey, they'll call Pat, they'll call me, they'll start calling you guys. Yes, I want to get into investing. I don't know how to do it, but like, you can help me out, explain what. And I tell them the basics are the three ways to invest. You can do a cash flow investment strategy, which means you want to cash flow the most amount of money possible every month. You don't care about appreciation. You don't care about other stuff. You just want to cash flow.
If you're looking for that, probably Hinesville is the place you want to be.
There are certain markets and
Yeah.
certain neighborhoods that if you want to make a ton of cash, that's the way to do it, right? So an example would be you buy a house today for $100,000 and you can make $500 a month in cash flow. And in 5 years, you sell that house for $100,000 because it doesn't appreciate. Certain neighborhoods won't appreciate, right? Some investors would like that. They don't care. They want as much money on a monthly basis as possible. I don't care what I sell it for. That's cool, right? Your option B is I don't want to make monthly. I don't want any cash flow on the equity game. I'm playing the long game. As long as my rent coming in covers my note, I don't care because I don't need it. I don't want it. I'm looking for a equity long game. So if you buy a house for $100,000, your mortgage payment $700. As long as I'm making $700 in rent in 5 years, that's worth $200,000, and that's what I'm looking for. I'm not looking for the monthly payments. Right?
Yeah.
So you got your cash flow option, boom. You got your equity play, boom. Now most investors want to be right in the middle, right? They want the equity and they want some cash flow. And that's where
you typically got to give one to get the other.
Yeah.
You know what I mean? Like you can get way more cash flow in West Savannah, but the appreciation, in my opinion, I know some people who think that that's going to be a hot place. I'm not really sold on it, but anyway, typically like Hinesville, for example, Hinesville appreciates whatever the BAH goes up, you know what I mean? Like that's what it appreciates. And it's not much, you know, but you can get some cheap houses out there. You can make some cash flow, you know, whatever. But then the kind of in the middle is kind of why I like East Side Savannah, because you're still getting decent cash flow, better than Starland. And I still think there's good appreciation potential over there. So, but I think like a straight appreciation buyer, they're buying in, you know, Starland, typically nicer places, and they're typically from out of state. Like, you know, people who live in Savannah and have been investing in Savannah, like they don't want to buy something on Bull and 33rd.
They want to buy it in a up and coming neighborhood because the appreciation, right? Like, so look at 33rd, your place on 33rd, right? That's a transition neighborhood, right? And Pat has a personal investment that's like, hey, I'm going to hold on to it because I think this neighborhood is going to appreciate, and it's going to be a good long-term investment. I'm
still making good cash flow on that. That was a total like a total gut job rehab, and that's something you talk about investors. Like if you really want value, you got to buy a shithole, and you got to make it nice because the buyer pool for a shitty house is just so much less competition. But more risk involved, more things can go wrong. I want 15 grand over budget, you know, shit happens, right?
But the question that you can ask, if you're talking to an investor, ask them up front. Are you looking for a cash flow strategy, or are you looking for an equity play? Or do you want kind of a hybrid, right? One that's going to give you credibility that you know what you're talking about. You understand the three basic buckets of what it is. And just because you or me or somebody might be all about this strategy, that the person you're talking to, that investor might be all about another strategy. So we can't assume that what we want in our own personal investment is what the investor might want. Because you have to ask them that. Are you looking for maximum amount of cash flow every month? Are you looking for a long play, kind of equity play? And most of them come back and say, oh, I'm looking for something in between. And that's where getting into the spreadsheet and the underwriting can try and maximize in between, because you are going to sacrifice one to the other, right? There's no way to, you know, you're going to be, you got to balance it. So, and the balancing, the threshold of every respective investor is going to be different on what they want to do. There are deals that I think are deals that other people don't think are deals. And there are deals that other people don't think are deals, or that do think are deals that I don't. Yeah. Because we all have our own. Everyone's got their own thing. And everybody sees, I always tell people, you know, like I always talk about East Side. I'm big on it. I tell my people, hey, I'm big on it. I own stuff over here, but I might be wrong. You know, there's other people who think this is the thing. The thing about real estate, you know, people think real estate's going to be, oh, this is a safe investment. This is, you know, and I think in some respects it is safer than, I mean, it's certainly safer than buying, you know, crypto. Yeah, right. But nothing's safe. I mean, nothing is safe. A freaking Category 5 hurricane could come in and just totally, you know, fuck Savannah. And if you look at what happened in New Orleans, I mean, there's still neighborhoods in New Orleans that have never recovered. Yeah. So, yeah. And so like nothing is safe. You never know what might happen. Managing expectations, this job's managing expectations. But like to Wynn's point, like, you know, Wynn's got a buyer that's got $2 million cash that she's got to get in something. And she's buying deals that, you know, I wouldn't buy, you wouldn't buy, you know, but like for her, for that investor, it makes sense. You know, I've got another client, you know, who has a lot of money that he's got to place. And for him, he doesn't need, you know, we did manage it. I actually found him a deal. I kind of wish I would have bought it myself, you know, last year. We put him on a duplex on market, you know, something I probably wouldn't have bought myself, but like still a good deal. It's in a good appreciation spot, you know, whatever. Everybody's got their own thing. So we kind of went off on a tangent, but you know, this will help give you kind of the tools for your toolkit. So
I got a question for you.
Yep.
So for us, I've done a few of these, but I'm still having issues going through understanding like the property valuation metrics, that section of it. What would you recommend for us to just do this and train and practice?
You could just use this for a couple different properties. I mean, really, you know, shit, why don't we,
can we do a real one? Just like,
yeah. Why don't we do one? I want to share my whole desktop here. So,
as I understand it, it's like I've done it a different way, and it's never been this accurate.
So I'm going to share the whole desktop here. So Anybody watching this should be able to see both windows. All right, here's my money here.
Yeah.
I made almost $1 today. I got my money. All right, let's look at a deal. Let's look at let's just look at a regular house. It's not a regular house. Let's look.
So we want to buy your.
So let's do one. Actually, dude, let's do one that this is a house I sold. Yep. All right. So this is a house I sold to a guy about a little over a year ago. He paid, and he didn't even buy this as an investment. I mean, he intended to rent it out later, but he needed a place to live. VA loan buyer, right? Sold for $289. So let's plug that guy in. $289. That same house that would sell for probably $330 right now. We actually bought that in like April, one under contract, like the worst of COVID times when like everybody thought so good timing on his part. All right, so $289. All right, repairs. I think he's put some money in it, maybe 5,000 odds and ends, you know. Rent estimate. So I think back then I told him it would probably rent for 2,000. I think he's got a little more than that. He's got it rented now. Let's just say 2,000. ARV, you know, we're going back then. It's worth about 300,000. All right, loan to value. Like I said, he's VA, so 100. Technically, the VA loan, because of that funding fee, they tack on the funding fee. We're just going to keep it 100%. We're just going to keep it simple. His rating was like dirt cheap. I think it was 2.5. 30-year loan. I don't think he got any points on that. All right. Yep. All right. Insurance. He's probably paying $1,200. Insurance is higher when you're living in it than when it's a rental property, by the way. So maintenance, that's $1,500 in a house like that. Vacancy 5%, property management 10%. Okay, cool. So let's go through our numbers, right? We've got a net operating income, 12,000, right? We've got our rent multiple, 147. That's a high rent multiple. That's, you know, pretty good. That's Ardsley Park. Like, that's a nice single family home in Ardsley Park. You're going to have to pay, you know, you're paying a premium, like the cap rate, 4.3%. That sounds about right. I mean, that's, you know, it's a nicer property in a nicer neighborhood. You know, you see how that changed, you know, that, you know, if that same house was in West Savannah, somebody probably want like an 8, like double the cap rate, which would mean if we double the cap rate, what happens to the purchase price?
Okay.
By how much?
Oh, I don't know how much. I mean,
You cut it in half.
Just cut in half.
If it's the same rent,
Okay.
you know what I mean? If it's the same rent coming in and a double cap rate, you know, so like, yeah. So that's how we're valuing that particular property.
I see.
So
Okay.
the rent multiple is higher. Now, and this is a deal that like a straight investor, you know, you're probably not going to buy that house to rent it out, right? This is a guy who was VA loan. He's going to live in it. He had to buy a house anyway. You see how we're looking at this? Mm-hmm. He had to buy a house anyway. So, all right. So what are we looking at? Principal and interest. All right. So here's his payment every month. Principal, interest, taxes, and insurance, $1,674. Right. We said it's rent for $2,000. That's what we estimated. So when I ran the numbers for him, you know, if we go through, here's our cash flow, negative $1,000, right? Mm-hmm. So I told him, I was like, look, you know, like, you're probably lucky to break even on this, you know, if you move out. Now, in, you know, 2 years time frame, as rents go up, you know, you're looking better. He was going to live in it for probably 3 years, but he ended up getting moved somewhere else like pretty quickly. So he ended up having to rent it out. I think he's getting $2,200 now. So he's making a little money, not much, right? But even with that negative cash flow, look at his total return. Sweet. Because he's paying down his mortgage, right? How much? $6,000 a year, right? He's paying down his mortgage $6,000 a year. and he's got the appreciation. So, you know, his cash ROI, negative 14%, right? Talk about leverage, right? Negative 14%. And the less money, say he didn't spend anything on repairs, that cash ROI is now negative 42% on the same exact cash flow, just because the denominator of that equation is so small. That's how, when I talk about leverage can amplify gains and losses, in this case, it's greatly amplified his loss, even though it's the same dollar amount, but when compared to his initial investment, right? Makes sense. But his total return on investment is 580%. You can see how you can lose money in a cash basis, but make money in other ways.
Actually,
right?
that's a lot more. It's probably like over 600 now.
Yeah. So, but I know he did spend about 5,000 fixing some stuff. So, you know, whatever. So, I mean, that's leverage, right? But that's that deal. That's Ardsley Park, you know, and for him, like I said, that's something I wouldn't buy that as a rental. He probably wouldn't buy that as a straight rental either, but he had to have a place to live and he didn't want to pay rent. He wanted, you know what I mean? So like, and here's something else that I didn't even think of that I want to bring up. Look at this principal and interest, right? It's pretty similar. They're both pretty close. As the interest rate gets closer to zero, all right, say your interest rate's 1%. It'll never happen, but all right, now look at that. Now you're actually paying more principal than interest. Even though I just talked about, what did I just talk about? I said, usually you're going to charge more interest. Say it goes up to 10%. All right, you're barely paying any principal. You're paying so much interest. That's just how it amortizes. So the lower the interest rate is obviously good because your payment's lower, but it's also good because the closer that rate gets to zero, right? If it was all the way at zero, say you got a loan, no interest rate. Well, you're paying nothing but principal at that point because there's no interest to pay. You see how, so you get a lower rate. That's also juicing, not just a lower payment, but it's also increasing the portion of your payment that goes to principal. So that's why low rates, this is a little bit of an aside, but like if rates go up to 10% tomorrow, there will be a massive real estate crash. I mean, prices would cut in half. Prices would cut in half overnight, right? If, if you're one of the people that believes in like a global conspiracy of, the elite, and they all got together and they said, we're going to crash the housing market today. Set rates at 10%. Yeah.
It'd be great if you have cash on hand.
It would be great.
Yeah.
If you were like the global elite and you had a bunch of cash on hand. So yeah, that's rates. That's a little bit of an aside on interest rates. Some movement in rates, 1%, 2%, not really that big of a deal, to most people. Anyway, so let's put that. Yeah, 2.5. So yeah, that's an always part deal. So you can see those valuations and all those metrics and stuff. So you talk about valuations, rent multiple 147 that deal. Let's look at a different deal.
Let's go to.
Where do you want to go? Where do you want to look at a deal?
Let's look at a nice shithole. I'm looking at quite a few. I want it like New Mexico Street.
You want to look at something in New Mexico?
Yeah.
All right.
I want to check out some of them.
How about?
I was going through that area. It looks really, really appealing.
Why don't we look at actually?
There's a nice small.
You know what, Lee? Well, Lee got that deal really good.
But there's a couple of them over there.
Let me call up. Let me just call up Lee real quick, see if he's got a second. Because he got a really, really good deal.
I think that was the one I went over. And
There's the one, yeah, it's the one you looked at. Well, the one that's finished.
Oh, okay.
Let me call Lee.
Hey, what's up, man?
Hey, Lee, how you doing? Hey, I'm going to head out, shoot pictures at your place here pretty soon, but I'm finishing up an agent training. We're going over investing math, and I just wanted that rental you just did. I wanted to analyze that for him. Can you tell me, what you got into it and what it rents for, if you got a minute?
Yeah, you're talking about the Beach Street that we just renovated?
Yeah.
Yeah, so this is an odd duck because it's got a clouded title.
Right,
So
right.
It's the math is going to be different on that. So I bought it for 20.
Yep.
With no title insurance.
Yep.
Put 35 into it.
Yep.
And it's currently listed for rent at 1,300. I've probably had 10 people want to submit apps already.
So you're gonna get your 1,300. Sounds like.
I think so.
That's awesome.
At least 1250.
That's a what is that? Is that a little 2-bed bungalow or is that a 3?
2-bed, 1-bath.
Jeez. All right. That's incredible. All right. I'm gonna run through. I don't want to take up too much of your time, but I'm just teaching them.
Yeah. So do
do
you have insurance and all that on that one?
Okay.
Yeah, I'm sure he's got
Okay.
insurance.
So
yeah.
Because I didn't know what the cloud.
I'll talk about cloud of title. Yeah, Lee. I think that's all we needed. Appreciate you taking a quick minute.
Right on.
Yeah, awesome. Thanks, man.
Well, then, I don't know if you want to share this or not. You can talk about it a little bit. But with the clouded title also. So, I got 2 options. I can either run a quiet title to get equitable fee simple so that it is marketable.
Yep.
Or even if we don't do that, in Georgia, since I do have I've got a limited warranty deed on it. I don't have title insurance, but I do have a limited warranty deed. In 7 years, I can use adverse possession to also get marketable title on it. So the equity can be realized. It's just going to take a bit longer.
Yeah. I'll explain that to them after we hang up, what that all means. But yeah, man, that's a sweet deal. That's a sweet deal.
It's a fucking money maker to have.
Yeah.
Good job, Lee.
Awesome, man. All right. Appreciate it. That's it.
Later.
All right. So Lee, this is Lee's deal. So I'm not gonna. It's over here. It's one of these streets. I forget exactly which one already. So Lee bought this place, and he's holding this thing cash. Lee. You would think Lee would be like levered up on everything. That's when I say levered up, that means leverage, get a loan. Lee, talk about different investing strategies. Lee wants to maximize the cash in his pocket. He doesn't care about the percentage cash return. He just cares about how much money's coming into my pocket, because he's trying to put together a smaller portfolio that's not leveraged, that he can basically, retire in 5 years and just make money, right? That's a different strategy. Me, I want to use leverage. Like that's just different things, right?
So for him, he doesn't have a loan. So
he doesn't have a loan on it. He doesn't have a loan on it. So, but what I'm going to do is a deal like this. If an investor does like a significant rehab, they're typically not going to leave this repair budget of 35 grand, like tied up in equity in the house. They're going to refinance it. So what I'm going to do is I'm just going to set this purchase price to 55,000. All right. And I'm going to set the repair to 0.
I see.
Well, he's all cash. But if another investor was doing this, typically they'll do the repairs and then they'll refinance it to pull the repair budget back out. It's called a cash out refinance, right? When we'll talk more about that strategy later. Just to run numbers on it. So say 55, that's incredible. I mean, that deal does not exist on the open market. Even that's an incredible deal, right? But let's run through the numbers on this incredible deal, right? What's it worth? He could probably sell that for 150 today. So say you're an 80% buyer, you're probably at 4%. Property taxes, insurance is probably going to be 750.
That's not much.
So what is this deal? This deal is incredible deal.
Wow.
So yeah, so you're, dude, 42 is his rent multiple, 42, right? That's super low. That means the rent's 1,300 times 42 equals his $55,000 purchase price. Incredible. That neighborhood, really 100 to 110 is what the equity multiple should be. So that's a way to value it. If you see this deal and you're like, holy shit, I mean, that's buy. Like buy it now. Like don't even look at it. Just buy it. You know what I mean? And really, deal like that, I'd be happy paying a rent multiple. Like say you buy it for 100 grand, 76. I'd be happy to pay 100 grand for that deal. I'd probably be happy to pay 120 grand for that deal. 92, right?
Yeah.
And most investors for 1,300 in rent over there, they'd probably be happy to pay 140,000. 107. That's what I said. 110 times rent for that neighborhood, you know, so you can see, and that's the other good thing about real estate is in the stock market, a stock like Amazon, there's so many buyers and sellers that the price, you know, it's very rare that you're going to be able to get a sweet discount on Amazon shares because there's so many buyers and sellers in that market. And it's a liquid. When I say liquid, I mean, it's easy to buy and sell. And now the only opportunity you had to buy Amazon at a steep discount was during the Corona crash last year. Yeah. If you were, you know, smart enough to buy some, right? So the other cool thing about real estate is you can find deals like that. Lee sends out all his mailers. He found a deal. This deal has clouded title. That means no regular buyer. You have to buy that cash. Nobody's even going to lend on that house. Mm-hmm. Like you can't even take out debt. No lender's going to lend you money for that house because it's got clouded title. Now he can go through a legal process. There's things he can do. This is not an investor. You don't know for sure who the owner is, basically.
We don't know who owns it.
Yep. Right now, Lee's got possession of it. He kind of has ownership, but it's disputed. It's kind of in dispute. And it's not somebody's disputing Lee. Somebody's disputing an earlier seller at some point in time. Who knows? Could have been the guy who owned it three times ago. You know what I mean? That's clouded title. In a couple of years, Lee should be able to fix that, and then he could sell it, you know, once he gets that fixed. Or there is a slight chance that somebody can make a legitimate claim against the property and take it. He rolled it for those kind of numbers. He rolled the dice, right? And that's how he was able, you know, he sends out letters. He's got websites, he markets. So he finds these deals off market. He goes to the seller, he establishes some rapport. He finds out what their problem is, how he can help, and he finds these deals, right? He found this sweet deal. So he's all in. Let's go back to his numbers. 55. Yeah. So he's making $7,000 in cash flow. If he's got it, you know,
it turns around.
If he's got a loan against it. If he doesn't have a loan against it, what's his cash flow going to be? If he doesn't have a loan, what's his cash flow?
Cash flow would be his rent minus
what?
Insurance, taxes,
minus expenses.
Yeah.
What do we call that metric? There's a word for it.
We call that metric. Why am I drawing a blank?
It's an income metric, right? Because we're talking about an income.
Net
operating income. NOI. So if he pays, and he did pay $55,000 straight cash, his NOI is $10,000. He has $55,000 invested. His NOI, because it's straight cash, is $10,000. Now, if he did take out a loan against it, right, 80% of $55,000, his cash flow would then be $7,500. Because he's paying $2,500 in principal and interest, right? So let's just say he has a loan, and it's still pretty good. Here's his total return, right? Which is cash flow plus appreciation plus principal pay down. $12,000 total return on $55,000 invested. So if he's got this loan, let's run the numbers like he doesn't have the loan, because he doesn't.
Yeah.
Let's take a look. 0% loan to value. So cash ROI, 17%. He's making 17% on his cash without a loan. It's incredible. Total ROI, 25% on that $55,000 investment. Basically, he's got with the 25% ROI, how many years does it take for him to get his initial investment back at a 25%? 4 years. So in 4 years, he's got all his money back, right? Now, yeah, let's put the loan back on it though, because most people are going to have a loan. So we put the loan on it. Bam, look at the numbers now. 56% cash ROI. In 2 years, you've got all your money back from your down payment. 2 years, right? Now, two things. First, I've not talked about ROE yet, so I'm going to talk about that. But I'm also going to talk about this purchase price of $55,000. Not a lot of lenders will give you a loan for that. Most lenders, I actually had a deal. I found a guy, an awesome deal on New Mexico Street a little over a year ago. Killer deal, smoking good deal. Just as an owner occupant, right? It was off market. I had to get Denise to do it because nobody wanted an assignment contract. Like all the other lenders that I talked to were like, we don't do assignment contracts. Denise was like, we'll figure it out. I was like,
Denise,
yeah.
you're awesome.
Yeah. So, you know, it was so complicated to get all the contracts and everything, but we got it straight. She closed on it. But the price, we were under contract for like 65,000. And she was like, it's got to be at least 75,000 or I won't lend on it. I was like, you telling me that we have to spend more money? And she's like, yeah. And I called my client. I said, we got you this great deal, but you have to pay more for it. And I walked him through it. He still did it because he was like, well, shit, at the end of the day, you know, so basically the seller got some more money, you know, and I think, I was like, all right, well, I'll buy you like a nice Home Depot gift card or something, you know what I mean? Anyway, that's the other thing. You could probably get private money, but you got to pay more for private money. You know, I'm talking your regular conventional loans, right? So, but return on equity, you see how low these two numbers are?
Yes.
What is, if return on investment is return over cash invested, what's return on equity?
Return on equity, I mean, that's just getting money from the house itself.
What's our equity? So what is the equity that Lee has in this property?
So he has, I mean, it's right around 100, or a little less, 95. Because it's the after repair value, 95.
So that is his free equity, right? That we talked about. 95 is his free equity, but his total equity is what? How much equity?
Would just be 150.
Would not be 150. So, but he's got, well, for him, because he doesn't have a loan.
Okay.
For him, it would be 150 because he doesn't have a loan. If you have a loan, your total equity is basically that ARV minus the loan amount.
Okay.
Right?
That makes sense.
Yeah. Equity, when you look at you know how a company has like a balance sheet? You can look at the balance sheet of a company. Are you familiar with that at all? Like, and on a balance sheet, you have assets, you have liabilities, and then you have equity, right? Are you familiar with that term at all? So you have, and it's the same thing with a company or real estate. It's a very similar thing. So if you look at the balance sheet for this property, you have assets of 150,000. That's the asset. It's worth 150,000, right? Asset, 150,000. Boom. Liability is your loan. What is your loan? What's 80% of 55?
120.
Well, no.
Oh, wait, what? Oh, 55.
55 is,
right.
so 55 is the purchase price. 55 times 0.8 equals 44.
Because I was doing
right?
it on the
So
ARV, which is incorrect.
So 150,000 asset, liability 44,000, right? And then we have equity. What is our equity? All our equity is 150 minus 44. All right, so $106,000
So equities ARV
minus loan amount, right? So whenever you look, that's how you figure out your equity, right? And any business, if you look at their balance sheet, right? The assets are going to equal liabilities plus the equity, the shareholders' equity, right? And any property, it's the same thing. It's a balancing. So the more you pay down the loan, that's why you have more equity. See what I mean?
Yep. So I was just doing it off of the ARV, which is incorrect.
Well, no, ARV is correct. That's what it's worth. That's the asset value. It's worth 150,000.
Or originally loan to value, I wasn't taking it off the purchase price.
Yes, you take loan to value off the purchase
That's
price.
where I messed up.
Yeah, loan to value isn't. I mean, in this case, there's two different ways. When the difference between the asset value and the purchase price is so different, a more correct way to say would be loan to cost.
Oh, okay.
But for this, we'll just leave it loan to value. It means to the lender, LTV, 80%. They're going to lend on 80% of the purchase price or the value of the property, whichever is lower for your standard investor. It's a little different when we do a cash out refinance. That's a little bit out of the scope. Right. So anyway, equity, he's got a shitload of equity in this deal.
Yes.
Right. That is the bottom of the return on equity equation. So even though, right, both of these equations have in the numerator cash flow when the denominator of equity is so much greater than the cash invested. That's why that number is so low. Why do we look at return on equity then? Why does it even, because it's good that he got so much equity, right? Why do we want to look at this return on equity? What happens as our equity goes up? Watch this. Let's say it's worth 200. Say in 5 years it's worth 200,000. Look how much our return on equity went down. It almost cut in half, right? As your equity goes up and you're making the same amount of cash flow, your return on equity gets lower. And so what that is telling, at least me as an investor, is I have a lot of equity that if I pulled this equity out, I could put the equity into another property. And as long as I'm making more than 3.68%, that's a better use of that money.
I see.
That's why we look at return on equity, right? I have, for example, an investment property with about $50,000 worth of equity in it, right? Somebody wanted to buy that off of me. And so what I looked at is what's the return I'm making on my equity in this property, you know, and I ended up not selling it because I said, well, I have a lot of equity, but I'm still making a good return on it. I don't think I could take that equity and put it into another investment and make a significant amount of extra money.
I see.
Make sense?
Yes.
What are our two ways to free up equity? There's two ways to do it. Refi or?
I only know refi.
Or sell the asset.
Oh, okay.
All right.
Yeah, I guess
so
the other one.
Yeah, so that's why return on equity is more important when you already own the asset, and you're going to see that return on equity probably go down as the asset becomes more valuable. At some point in time, the investor is going to say, you know what, let me free up some equity either in a sale or in a refinance, or you could even do a HELOC. You know, that's why I keep it in here. It's not super important when you're going to buy the place. You're more interested in your return on investment. But if you already own it for 10 years, run the numbers on something you already own. What's my return on? Oh, it's not that great. I should sell this, maybe buy something else or refinance it. And so, you know, yeah, return on equity. There we go. Make sense?
Yes. Now it does.
Yep. So, all right. So before we wrap it up, this is a sheet that I made, and I'm going to change my screen share now. So anyway, we did this neighborhood, 110 times rent, kind of in the States, in the state streets, 110 times rent versus Ardsley Park, 150 times rent, right? Two different neighborhoods, two different valuations, right? What would the cap rate be? Let me do the cap rate on, so what did I say? For 1,300, somebody would probably pay 140 for 1,300 in rent.
Yeah, we were right there.
So cap rate 6%, 6% cap, 6.16% cap rate versus what was the one in Ardsley? It was like 4.3.
It was lower.
4.3, right? So Ardsley, more desirable neighborhood, more desirable asset, lower cap rate. Makes sense. Yeah. So that's why if you're looking at a deal in Ardsley Park, and if you can get a deal in Ardsley Park that's a cap rate of 5%,
that's good.
You say, you know what? This is a better investment than most of the other investments in this neighborhood. And you can say to your investor, hey, this is a better deal than most of the deals that you can buy in this neighborhood. Meanwhile, over here in the States, now the thing about the state streets and in this, here, I'll point with my mouse so anybody on the video can see it. In this side of Savannah is it can be very block to block.
Yes.
So you have to drive the block. You really have to drive the block.
And that's what I was doing down there. I was checking out that whole area.
And like, for example, like some of these parts of Mississippi are kind of gross. You know what I mean? You know, if you're buying something in some of these parts, you probably want to get 90 times rent. Whereas, you know, so this is Mississippi. There's, where's that? Vermont. All right. Just right over here. Just a couple streets. It's just a lot more desirable over here. A lot more desirable over here. A lot more desirable over here. Then you even got Gordonston, which is like, you know, nice, you know, and that's just a couple of blocks. That's how Savannah is. Ardsley's more homogenous. Like all of this is pretty solid, you know, but Parkside, you know, on this street, you would pay 150 times rent for a place. On this street, 100, 110, a couple streets, really just crossing 52nd Street. That's something you get, you just get a feel for it. I mean, there's a block, you know, one of my clients bought a place, I think like right here, just a dumpy block. There's a freaking, like a literal trap house on this block. You know what I mean? But you know, just over here ain't so bad.
Oh yeah.
You know, and that's, yeah. So property valuation metrics. I'm gonna jump back to just this one screen real quick. Because I want to go over, this is a spreadsheet I put together, my rent versus own spreadsheet. So I made this a little more user friendly, I guess, you know, for like this is more home buyer, but still wants to know they're getting a good deal, right? So, you know, let's look at let's look at the one on Columbus. What did he pay? $290 for it, I think. You know, he was all in it for I think he got a lot of his closing costs. Let's just leave it at 3,000, and then he did, you know, $5,000 worth of work. All right, cool. No down payment, no PMI because it's a VA loan.
Yep.
Interest rate, loan term, perfect. All right. Now we say, hey, if you're going to rent this place, or if you're going to rent any place, what would you be paying to rent? You know, all right, maybe 1,500. I don't know. You know, 1,500.
For this one, I think you said 2,000.
Yeah, well, that's current market rent for the property being analyzed.
Okay,
2,000.
2,000.
I'm just, you're gonna have to talk to your buyer. Hey, look, you're renting right now. What's your rent? Okay, it's 1,500. Cool. All right.
Oh, okay.
You know, say, hey, how long do you want to own it? This only goes out to 8 years. So he says, I want to hold on to it forever. All right, 8 years. How long are you gonna live here? 2. Okay, cool. And then we have, you know, appreciation, 3%, property taxes. I got a little calculation here. Savannah tax, 5,100. You see the islands is a little cheaper because it's, yeah. So HOA dues, nothing in Ardsley, maintenance. So you know how on the other sheet I had maintenance and Capex together? On this one, I broke it apart.
Smart.
Because your Capex, if you spend $10,000 on a new roof, right, and you had an old roof before and now you have a new one, typically your house is going to be worth close to $10,000 more. So Capex is kind of like paying down your loan. It's money that goes out of your pocket, but kind of back into your house. Whereas a repair or regular maintenance, that's not making your house more valuable. That's just shit you're supposed to do anyway. You know what I mean? So now, all right, here's the results. If you live in this house for 2 years and you own it for 8, you will be better off to own, right? It doesn't always say this. I don't rig it. You know what I mean? This is how much money, this is how much more money you'll have when you sell versus if you never bought it, $153,000. In 8 years, he's going to have $153,000 more dollars in his pocket than if he just rents and doesn't buy anything. Pretty sweet, right? And this is the check he'll get when he sells it, right? Why is this number so different? Couple of reasons. The biggest one is that's $1,500 every year he's not paying him rent. 1,500, you know, 1,500 times 12 times 8 is 144,000. Right now he's paying anyway, but that's why that's so different, right? Now here's his cash flow. So while he's still living in it, he's actually kind of losing money cumulatively because his mortgage payments is more than the rent he was going to pay, right? So I'm saying, hey, look, year one, you know, you're 3,600 in the hole. You know, year two, you're 7,100 in the hole cumulatively. You know, that, you know, say we're on 5 years, right? You can see how that changes. So I say, look, you're paying a little more in rent, you know, whatever. If you were already paying 2,000 in rent,
there you go.
You got more, right? Why is that? Because your mortgage payment's lower than 2,000, right? And then this is how much profit or loss you get every year when you're renting to somebody. And you see he's got $1,100 in cash flow and it goes up every year. Why? Because typically rents have increased more. You know, your rent goes up, your mortgage payment stays the same, right? So this is a sheet that I use for people. And this is a good, like, I don't send this to everybody. Not everybody wants to see this, you know what I mean? But some people do. You just kind of feel out the client, you know, like, hey, is this something they want to see? Maybe if you got somebody who's on the fence, like, oh, these prices are so high, you know, say, look, I mean, the prices are high, but what do you know, and it might not work out for everybody. I've run into some people and I'm like, you know, for what you want to buy, you know, sometimes typically it comes out better to own, but for some people, you know, like say he's like, I don't want to ever rent it out. I just want to sell it. So he's going to sell it in 2 years. All right. Well, he's still better off owning it, but he's going to have to cut a check to sell it, you know, because basically, the VA loan, you don't have any equity. So when you sell it, you got realtor expenses and stuff like that. So you can see the difference. Most of this is from appreciation though. You can see if we change appreciation, say we set it to 0, you know, that changes the number quite a bit. But yeah, that's a good spreadsheet. So we're basically at 2 hours now. I don't expect you to know. I don't expect any of you guys to know it all. I mean, this is, you know, we can do more of these and get into more detail, but you should now have a baseline. If you want to go do your own reading and your own research, you know, hopefully it'll be more productive. Yeah.
It's good stuff.
So there it is. So for the Wynn's listening in here. For the YouTube watcher, I will put contact information for me and my company in the comments. We are Trophy Point Realty Group, located in Savannah, Georgia. My name is Pat Wilver. I'm co-owner of the company. This was a regular agent training. We try to do these once a week. We'll be putting this up on YouTube. So got any questions, you're interested in talking about Savannah or real estate investing or whatever, please do not hesitate to reach out. Awesome. All right. Take care, guys.